The industry narrative of a stock picker's market is offensive. There have been countless heated arguments that have persisted through the ages based on the counterparties reversing the onus on one another while insisting their own view is unambiguously accurate. Other things can be proven through logic, but misconceptions nonetheless persist because humans are intellectually lazy and would rather believe in things that simply feel right. That's where many conspiracy theories come from. According to Wikipedia, a conspiracy theory is an explanation for an event or situation that asserts the existence of a conspiracy by powerful and sinister groups, when other explanations are more probable. The term generally has a negative connotation, implying that the appeal of a conspiracy theory is based on prejudice, emotional conviction, or insufficient evidence. Conspiracy theory refers to a hypothesized conspiracy with specific characteristics, including, but not limited to, opposition to the mainstream consensus among those who are qualified to evaluate its accuracy, such as scientists or historians. Conspiracy theories are generally designed to resist falsification and are reinforced by circular reasoning. Both evidence against the conspiracy theory and absence of evidence for it are misinterpreted as evidence of its truth. In the world of finance, one such theory revolves around the phrase stock picker's market. Now, part of the problem is that the phrase itself means different things to different people. So for most people, it means a set of circumstances where stock picking is likely to be more profitable than would otherwise have been the case. But every year, investors are promised a stock picker's market that never seems to materialize. The investment industry is perpetually claiming that the moment has arrived for active investment strategies to carry the day over low-cost index funds. Well, here's the evidence. Last year, fewer than 1 in 5 actively traded investment funds in the U.S. beat the S&P 500 index in the first half of the year, according to data from research firm Morningstar. Canadian active fund managers didn't have a great year either. Only 1 in 4 funds focused on U.S. stock picks has outperformed that market. And Canada-focused equity funds, meanwhile, had a slightly better record, but even then, only 1/3 of all funds surpassed the S&P TSX Composite Index. People in finance have used the phrase stock picker's market repeatedly for about a century with impunity. The financial press lets them get away with the fairy tale. In addition to resisting reliable and consistent definition, the phrase seems to mean different things to different people depending on the circumstance and the audience. If you were to ask a person on the street what the term means, the most likely response would be something that suggests favorable circumstantiality. And that makes no sense. The odds never change, so circumstances don't matter. When the people who want to know better are willing to repeat and normalize a rationale that defies logic, the public is at risk of being bamboozled by those who have clear vested interests in having the public misunderstand things. Winners only exist because they trade with losers. But in some, their results are average. Whatever stocks are traded, the extent to which one party gains is equal to the extent to which the counterparty loses. This is true for all asset classes and all jurisdictions over all time horizons. There are no exceptions. This is true over any time frame. Widen the lens out to a decade, a long enough stretch for any stock picker to prove their mettle, and the results are similar. The industry points to the exceptions as if they somehow disprove the rule. In simple terms, the logic behind saying we're in a stock picker's market is akin to suggesting we're in a lottery number picker's market. The intellectual gymnastics required to believe in such spurious reasoning would be humorous if it weren't so tragic. It's disingenuous to imply circumstantiality where none exists, yet the finance industry does it all the time. The odds of winning the lottery never change, and similarly the odds of outperforming a benchmark by picking stocks never change. Ironically, in this perverse morality tale, the sinister group of conspiracy theory is played by functional and logical stock market. The financial services industry would have the public believe that there are times when stock picking is a more profitable approach than others, and that indexers are the conspirators. The self-interested prejudice and emotional conviction of the industry comes from its active resistance of common sense, both by industry practitioners and their clients. Big finance has been baffled by its own bullshit. There is no evidence to support the existence of a stock picker's market, even in theory. But that hasn't stopped stock pickers from insisting the circumstances exist. Indeed, the narrative has persisted for nearly a century despite the securities industry having supposedly strict regulations that prohibit making statements that are false or misleading. Presumably, if it is rational to pick stocks when we're in a stock picker's market, it would be irrational to pick stocks when we're out of a stock picker's market. And if a stock picker's market were genuinely possible, there would be products that engaged in active management, stock picking, while we were in a stock picker's market, and that tactically moved to an indexing strategy when we were not. Alternatively, there could be products that exist during a stock picker's market that, no matter how many assets were gathered, would ethically close once the stock picker's market ended, since the product's fundamental purpose would have ended as well. And if it's always rational to pick stocks, then why speak of favorable circumstances? For instance, if one was to take the cynical and self-serving position that it's always a stock picker's market, then that would beg the question that comes from the terminology revolving around the word entering. How exactly does one enter an environment if that person is already in the environment? There are no tactical stock picking products because the industry knows it cannot reliably manufacture anything that substantiates its not so subtle lie. Finally, have you ever noticed that the only people who talk about stock pickers markets are the people who actually make money by picking stocks? Have you ever noticed that they're eager to opine that we're entering into a stock picker's market without ever allowing that we may have exited one? The phrase is designed to get people to trade more and to pay more in fees because trading generates revenue and activity that's used to justify the fees. It's well known that if you repeat a lie often enough, people will have a difficult time distinguishing fact from fiction. The notion of a stock picker's market is nonsensical. It's high time that regulators punish those parties that suggest otherwise. Investors are paying billions in fees for services that, in aggregate, add no value whatsoever.